Thank you so much. My name is John Mukundi. I am a lecturer at Achievers College, teaching financial accounting. And today I want us to do a topic in financial accounting that is called control account. So we are doing control accounts. Now, what we need to understand in this manner is what is control account. We need to know what control account is all about, and we need also to understand the advantages of drawing control account and advantages of drawing control account, and we also require to know the sources of information of drawing control account, sources of information of drawing control accounts, and we also need to understand the types of control accounts, and we need also need to know how to draw control accounts. Once we, and the last thing before I forget, it is also dealing with errors as far as control account is concerned. Now, we need to begin by the meaning of control account, And when we talk about control account, it is important that you understand the accounting cycle. And the accounting cycle has various particular steps. The first step we have in the accounting cycle, is number one, we deal with the source document. We have to have in the accounting cycle source documents, and the source documents refers to those documents that support a transaction. There are some documents that support transactions, and those documents that support transactions are known as the source documents. Examples of these documents are things like receipts, cash sale receipts, things like invoices, things like credit notes, and all those, they are simply called the source documents. The bills, all those are simply the source document, and therefore as accounting starts, you have to start with the source document. Now, the second cycle, the second step in the accounting cycle is what we call the journals. It is what we call the journals. Now, recording of the journals. Journals simply means the prime entry books. Or they are also known as books of original entry, or they are also known as the journals. Now, these ones are books where transactions are first recorded. The first transaction, the first recording of any financial transaction goes into the journals. It goes into the journals. And these journals, example, are the sales day book. They are also known as day books, by the way. Sales day book, purchases day book, returns day book, returns in one's day book, returns out one's day book, cash payment day books or journal, cash receipts journal. All these are simply the journals or books of original entry where transactions are first recorded. Then from there, we record what we call the ledger. We record what we call the ledger book. And when we talk about the ledger book, we are talking about a book where accounts are kept, books where ledger accounts are kept. There are some books in which we maintain accounts. Then this one is what we call the ledger. And we have three categories of ledger. We have purchases ledger, sales ledger, and also a general ledger. We only have those three types of ledger in financial accounting, though we can have many other ledgers in other disciplines of accounting. Then from there, these ledgers, they use the principles of double entry when it comes to recording them. And then after we draw the ledger, we move to the trial balance. We have to draw the trial balance. Trial balance is a list of balances extracted from the ledger accounts. List of balances extracted from the ledger account. And it is self-balancing, and though there are some errors that it may not show, it is actually used to test the accuracy of the ledger. Then number 5, number 5 step in the accounting cycle, it is the financial drawing of the financial statements. We draw financial statements. Now, financial statements, again, they are three common ones. We have what we call income statement. We have what we call income statement. We have what we call the balance sheet. And we have what we call a statement of cash flow. Now, income statement is a statement of financial performance. It shows how you are performing in terms of profit, and that is what we call the income statement. Balance sheet is a statement of financial position. It shows your assets and your liabilities. That is what we call the balance sheet. Statement of cash flows, it shows cash inflows and cash outflows of the business. Then from there, what we do is we do analysis of accounts. We do financial analysis, and in this case, we analyze how well we are doing in terms of ratios and other types of ways in which we can do analysis. And we check our trend analysis, and we can also check our industrial performance. Now, we check how we are trending over the years, or we compare ourselves with those people in our industry to be in a position to know whether we are performing well or not. Now, in small organization, then you realize when it comes to people like debtors in small organizations, it is very easy to know them. But when we talk about a big organization that has so many clients, it becomes the volume of financial transactions is very huge. And because the volume of financial transaction is very huge, then we require a way in which we can be in a position to check the accuracy of our ledger book. So because once you reckon this on ledger, it will affect the trial balance, it will affect the financial statement, and it will affect our analysis. And therefore, we have to check the accuracy of our transactions, and we have to keep on controlling because of the voluminous transactions that are involved. And in that case, then, that is the time we draw what we call control accounts. That is the time we draw what we call control accounts. And therefore, what are control accounts? Now, control accounts are also known as controlling, just as the name is suggesting, controlling accounts. And therefore, they are simply the total accounts that are usually kept in the general ledger. Remember, I have said there are three types of ledger. Now, purchases ledger, you keep the accounts of creditors. It is also called creditors ledger. Now, sales ledger, you keep the accounts of accounts receivable or debtors, and therefore it is called the debtors ledger. But there is any other information, any other account that is not of debtor or it is not of creditors, it is usually kept in the general ledger. And therefore, general ledger will keep any other accounts like accounts of incomes, accounts of expenses, accounts of assets, accounts of liabilities. These ones are usually maintained in the general ledger. They are usually maintained in the general ledger, and therefore you need to know that any other account, including now control account, is kept in the general ledger. And that is why we have said the control accounts are generally total accounts. Why are we calling them total accounts? They are total accounts because what we do is that we get the primary books or the journals, and we get the totals of the journals, and once we get the totals of the journal, then we use those totals to draw control accounts, and therefore they are the total accounts that are kept in the general ledger that summarizes the totals of the subsidiary books. Subsidiary books is also journals, it is also day book, it is also primary books that summarizes that totals, and they are usually used for control purposes. They are usually used to check the accuracy of the in recording the financial statements. Now you also need to understand that control accounts are usually memoranda accounts. What we mean by memoranda accounts is we mean that control accounts are accounts that do not follow double entry rules. We do single entry as far as control accounts are concerned, and that is what you need to understand today. Now I keep on asking myself, what are the advantages of control account? What are the advantages of control account? Now we have various advantages of control account, which I'm going to enumerate for you, and I'll give you around 4. Now when we talk about advantages, we are also talking about uses. We are also talking about uses of control accounts. So if somebody asks you what are the uses, what the advantages, it simply means the same. Now advantage number 1 is that you see control account use totals, and because control account use totals to draw them, then it simply means that control account will give you summary, will summarize. It will summarize what? It will summarize transaction. It gives you the summary of transactions. Now that is one of the reasons why we have control account, to summarize transactions. And the second reason why we use control account is because control account will always provide accurate figures. Now it checks the accuracy. It checks the accuracy of records, of financial records, especially of debtors and creditors, especially of debtors and creditors. What it does, it gives you the accuracy. It tests the accuracy of the figures of debtors and creditors. Number 3, control account can provide, can give fast figures. It can give you fast figures, figures very fast when you are drawing financial statements. Now sometimes, you know, when the financial year end and the time that we present financial statements, sometimes that time can be long enough, and therefore for us to be in a position to draw our financial statement very fast, so that we eliminate that time lag between the time we report and the time we end our financial year, then control accounts will bridge the gaps. That simply means it bridges the gap. It bridges gap between the time of the gap in time between the time of presentation of financial statement, because it can be in a position to give you figures in time. And then control account is also used for internal checks. It is an internal control system. It enhances your internal control system, and that is why they are used. It gives you some internal check. It is very, very important that you note that. And then it also provides a basis for correcting errors, basis of correcting errors. It gives you that basis of error correction. That is one of the reasons why we also have control accounts. It gives you the basis in which you can be in a position to control errors. Now, what are the sources of information for drawing control accounts? The sources of information for control accounts. It is also important that you know how we get information that we use to draw control accounts. The sources of information, for control accounts. What are the sources of information? Where do we get information that we use to draw control accounts? Now, as I have said, we get it from the day books. Now, you realize that if we get it from Ranger, assuming that we have data A, we have data A, and we have data B, we have data B, and we have data C. We have data C. Supposing data A bought goods worth 700, supposing data B bought goods worth 300, and supposing data C bought goods worth 200. Now you realize that once we have that in the ledger account, many of us may assume that when we are drawing control account, when we are drawing debtors control account or accounts receivable control account, then what happens is that we should pick this and this and this, and we say these ones are our debtors. We bring these ones here and we assume this one is our debtors, and therefore we say our accounts receivable or credit sales is 700 plus 300 plus 200, which should be 1200. Now that one is wrong. This one is not where we take our financial statements. This is not where we get our figures from the debtors. I want you to show how we get our figures from the debtors. This is something else that we call the sales day book. Now, sales day book, you realize it will have the data, and therefore we have data A, data B, and data C. Data A and data B and data C will be 700, 300, and 200. So we get the total here of 1200. You can see the information is the same, but this is not where we get it. This one is wrong. We do not get it from here. What we do, we get it from this total. That is why I said this is the total that we use. That is the correct way. We extract information from the day books, and the day books that we have is the sales day book, and therefore the source of information for you to be in a position to get the debtors credit sales, you get it from the sales day book. For you to be in a position to get the purchases, the purchases that have been done on credit, you get it from the purchases day book. The goods that have been returned or any overcharge, you get it from the sales returns or returns in one's journal, returns out one's journal, purchases, returns, cash book, for you to be in a position to know who is buying from you. In short, that is how we are able to get the information for drawing control accounts. That is it. Then there is something else that I want you to know, and that is before we do an illustration, there is something else that I would want you to know. And the thing that I want you to know is that what do we call a set of? What do we call a set of or what do we call a contra entry in control account. Now, contra entry is not a very new term to you, because also in cash book there is something that is called contra entry, and I will also call it a transfer under this case. Now, contra entry is where double entry is completed in the same book. Where double entry is completed in the same book, that is where that is what we call contra entry. Like when you withdraw money from the bank and you bring it into cash, you know you are completing double entry in the cash book, and therefore that is what we call contra entry. In our case here, there is where we have a creditor. A creditor is somebody who is selling to us. Okay, we are buying from somebody we buy from on credit is who the person we call the creditor, and we have the debtor. The debtor is somebody who we sell to on credit. Now, the person we sell to on credit and the person we buy to on credit, they are known as debtors and creditors respectively. And therefore, in control account, you remember there is creditors or purchases ledger control account, there is debtors ledger control account. Now, it simply means that if the same person is the debtor and is the creditor, then we call that one contra entry. You do not require to keep on thinking so much. Supposing you somebody you are dealing with is selling you and you are selling it to him. You are selling, each one of you is selling to him, or each one of you is buying from each other. Then automatically that simply means the creditor, it is the same as the debtor, and therefore what happens in this, in both cases, this one reduces the debt in both cases, because if I buy from you 700 worth of goods, and if I sell 300 worth of goods, then we can say this is the literal. The literal is the one that is used to set off. The literal figure is the one that is used to set off. We can say automatically, if I am buying from you, I have only a debt of 400. So what we have done is that my 300, we have subtracted 300, and your 700, we have subtracted 300, and therefore the 300 we have simply set off. It simply means that you have my 0 debt and I have your 400 debt. We have simply set off, and therefore in both cases we reduce the amount of debtors and creditors in control account. Where the customer and the supplier is the same person, then that is where contra entry or setups come in. Now, I also want you to understand something else. There is what we call unusual balances. Unusual balances in control accounts. Unusual balances. Now, unusual or abnormal balances. Now, when we talk about abnormal balances, you need to understand one thing, that when we talk about debtors is an asset, and because debtor is an asset, they should always have a debit balance. It should always have a debit balance. Creditors are liabilities. Creditors are liabilities, and because creditors are liabilities, they should always have a credit balance. But there comes a situation whereby the debtors have a small credit balance, and creditors similarly have a small debit balance. Now, this one now is what we call abnormal balances. This is what we call abnormal balances. Now, they come as a result of what really brings these abnormal balances. Now, two reasons why we have abnormal balances in accounts. And one of the reasons why we have abnormal balances is returns. And why do we return goods? Especially when you are taking a crate of sonda you are buying, and the person tells you that these sonda containers are returnable containers. It simply means that you leave some deposit, and then from there, when you return, then you can be in a position to be given that money. So it simply means that returns can come as a result of when they are returnable containers. In case of returnable containers, we can have returns. And in case of things like what? In case of things like defective goods, we can have returns, defective goods, and such like things. We can have such kind of returns. And when somebody returns, and you know it takes some process, could be a process for you to be in a position to return back the money, it simply means there will be the creditor will be owing you. That means they will be having a debit balance, and when they have a debit balance, then it becomes an unusual balance. And there is something else that causes these abnormal balances. It is when we have what we call overcharge. Now, when you overcharge a person, there are some times when you have overcharged the person, and it can also come as a result of perhaps you have returned some goods and the person you had issued an invoice. Then it simply means that person is usually overcharged, and we correct that through some other source documents. So when there is no sufficient debit balances so that we can be in a position to absorb such kind of things, abnormal balances, they have to temporarily remain there for the time being. And once they remain there for the time being, it simply means that they will be abnormal balances. Now, we need also to speak about the types of control accounts. The types of control accounts. And when we talk about types of control accounts, we have, I will concentrate with the only two for this particular class. One control account I will concentrate with, it is debtors control account. Debtors control account, which is also called sales ledger control account. Sales ledger control account, which is also called, remember, debtors, in other ones, they are called accounts receivable. So it is also called accounts receivable control account. Account receivable control account. And this particular control account, it is the account in the general ledger. It is that account in the general ledger that shows the totals of all transactions we have a hand with the debtors within a certain financial year. The totals. Remember, I've said in control accounts we deal with the totals. They are total accounts, and therefore they show the total accounts and the total dealings, the total transactions that we have ever had with the debtors within a certain duration of time or a financial period. And we have the second one, which is called creditors control account, which is also called purchases ledger control account, which is also called accounts payable control accounts. Three ones: accounts payable control accounts. Now, when we talk about that, we are talking about total creditors, and it is that account in the general ledger that shows all the transactions we have ever had with the creditors, all the transactions we have ever had with the creditors. I want us now to do an example, and that example we will do, you'll display it on your screen, and I want to do the Chilvers and Company. That is the example that I want to show. Now, Chilvers and Company balance is purchases and sales ledger control accounts monthly. They do it monthly. From the following information for the month of May 1983, you are required to complete the sales ledger control account and bring down the balance as at 1st June 1983. And we are given the transactions there. Credit purchases in credit balance in purchases ledger 988. Credit balance in the sales ledger, you can see we have credit balance in the sales ledger, a small balance. It is 154. That one is an abnormal balance. And debit balance in the purchases ledger 63. Debit balance in the sales ledger, that is 699. Now, if you see the debit balance in the purchases ledger, you automatically know it is also an unusual balance. Purchases for the month 29, and I want you to notice that also we do not deal with the total purchases. We only deal with those purchases that are usually credit purchases. So purchases for the month 29, 63. Sales for the month 8,503. Returns in ones for the month 183. Returns out ones for the month 110. Credit notes sent to debtors for 40 goods not returned to Chilvers and Company 46. Cash paid to creditors, 2649. Cash paid to customers 6964. Discount received 60. Discount allowed 95. Bandits written off during the month 10. Debit balance on sales ledger set off against purchases ledger, against balances in purchases ledger 50. That one is what we call a set off. Then we have been told debit balances in the purchases ledger. That one again is a small balance, abnormal one. You can also be given in the question, and could be this in this question it is not there. Then credit balances in the sales ledger, again that one is not also given. It is an abnormal balance, and therefore we are required to draw the purchases ledger. We are also supposed to draw the sales ledger. Now, for us to draw the sales ledger, this is how you are supposed to draw it. The sales ledger, remember, this is a debtors ledger. So sales ledger. So if it is a control account, now if it is a debit ledger, then you need to a debtors ledger, then you need to know the balance of debtors is always an asset, and therefore the bigger balance, which should be for the debtors, should be the debit balance in sales ledger. Now we are also told about the creditors ledger, and therefore we will also draw the creditors ledger. creditors, which we call purchases ledger, control account. We are also supposed to draw it. So if we read bit by bit, credit balance in purchases ledger is 988. Credit balance, so you write balance here, balance brought down is 988. We'll ignore the dates because could be they are not necessary. We only have two dates. We only have the first date to give you the opening balances, and we have the last date to give us the totals. So even if we ignore the dates, it won't make any sense. Then credit balances in the sales ledger, so which is an abnormal balance. This one is an abnormal balance of 154. It is an abnormal balance of 154. Then debit balance in the purchases ledger, which is an abnormal balance brought down in the purchases ledger, which should be 63, which should be 63. And then credit balance, debit balance in the sales ledger, balance in the sales ledger, which should be that 699. That 699. That is something that I want you to know, that that is how it should be. Now I want you to notice that there is a very simple principles that we use to draw the control accounts. Debtors, anything that increases debtors, anything that increases debtors, it is actually debited in the debtors control account. Anything that reduces debtors, it is actually credited in the control account. Reason is because if you are increasing debtors and the asset, you should debit. If you are decreasing debtors and the assets, you should credit. Similarly, anything that increases creditors, should be credited. Reason is because creditors are liabilities, and anything that reduces creditors, then it should be debited. Reason is because creditors are usually liabilities, and anything that reduces liability, according to the double entry principle, it should be debited. So that is the principle that we are going to use, and that from there, if you are able to keep the balances in place. And we move to the transactions now. Purchases for the month, we are supposed to assume that everything that is done there, it is actually credit purchases. We need to assume that is credit purchases, and therefore purchases for the month, assuming it is credit purchases, and sales for the month is also credit sales. So purchases for the month, the question is, when you purchase on credit, do you increase creditors or do you reduce? And the answer is very simple. When you purchase on credit, you increase creditors. Anything that increases creditors, you credit, and therefore credit purchases should be credit purchases should be 2963. Now sales for the month, credit sales, does it increase or reduce debtors? Credit sales, it will increase more debtors, because the more you sell on credit, the more debtors you have, and therefore credit sales you debit because it earns the creditors credit sales, which is 8503. That is, you debit. Then returns in ones for the month. Return in ones, you hand sold. If it is in ones, you hand sold. So people are returning to you in. They are returning into your premises, and therefore it is reducing the amount that you hand sold. If you hand sold to them more and they return, they reduce, and therefore it reduces the sales. So you credit on the total debtors. So we have returns in ones. We have returns in ones, which should be a total of 183. It is supposed to be credited in the sales ledger. Now, returns out ones. Returns out ones, again, they affect creditors. Why? Reason is because you hand bought, so it is you that is returning. You cannot return in if you hand sold. You can only return if you hand bought. So you are returning out, and therefore returns out ones will reduce the amount you hand purchased. What you hand purchased, it will reduce as a result of returns out ones. So you reduce it, returns out ones, it affects, so it affects the creditors 110. Now credit notes sent to debtors for 40 goods and not returned. Now credit note is a source document that is used to correct an overcharge. It is a source document that is used to correct an overcharge, and therefore it also affects what we call returns. It also affects what we call returns. Now sent to who? To debtors, and therefore what is affecting is not here, it is affecting here. So we have some other returns in ones. Now returns in ones, know that we are reducing, and therefore credit note sent to debtors for 40 goods of 46, we also reduce the amount that debtors owe us. Sent to debtors for 40 goods not returned. Then cash paid to creditors. Cash paid to creditors. If you hand their debt and you pay cash, if they you hand their debts and you pay them cash, it simply means you are reducing the debt that you owe them, and therefore cash paid to creditors will reduce 2649. Will reduce cash payments. That is what we will do to your creditors ledger. Cash paid by customers, they will also reduce the amount they owe you, and that is why 6964 is supposed to be credited. That one again is cash receipt. This one should be receipt, this one should be cash payment. Now you need to understand that particular thing. Now if you give your clients discount, that means that we have discount received, discount allowed, and there is what we call discount received when they give you discount. In both cases, if you are given or you give, it reduces the amount of debt, and therefore discount received, because you are the one that and purchased, you are the one that is receiving the discount. It means you are the one that and purchased. It simply means that discount received will reduce the debt to your creditors. Discount received, so it goes again to the creditors. Discount allowed, it reduces the amount they are supposed to pay you. Discount allowed of 95. Discount allowed of 95. It also reduces that amount. Bad debts during the month. Bad debts. Now, bad debts is not for purchases. Now, bad debts is for debtors. Now, it is debtors that can refuse to pay you, and debtors that can become they can default in paying you. and therefore bandits, it reduces the debts, it reduces the amount of debt if you write it off. Now that one should be 10. Now I must say at this juncture that there is what we call provision for bandits. Now provision for bandits does not entail a situation whereby debts have been written off, no, and therefore it does not affect these accounts. If there is any provision, remember provision is money set aside for a particular reason, and therefore you cannot set money aside and reduce your debtors, no. What happens, that one will be shown in the balance sheet because it is an internal thing of the company. It is not something that has an effect of debtors. But when the debtor dies and or he is declared bankrupt and you cannot recover the money, at that particular time you write off the debts. So provision for bad debts is never threatened in the control accounts. And also cash receipt, cash sales and cash purchases, they appear nowhere, because when you sell in cash there is no debtor and there is no creditor, so they cannot appear anywhere in this particular issue. Then debit balance against on the sales ledger set off against purchases ledger. Remember I told you set off is simply when I have your debt, you have mine, and therefore the one with the retro we say we settle it. We assume that the one that has much, the balance on top is what they are going to pay. So in this case, set off will affect both accounts. So set off here, it will reduce the creditors by 50 and it will reduce the debtors by 50. So that one is a contra entry. Remember we said that. Now there is also something that is given there, the debit balances in the sales ledger. Debit balances in the sales ledger should be put here, balance CD, but we are told it is nil. We have zero. We do not have any debit balance. In case you're given a debit balance, it should appear there. Now the credit balance in the sales ledger, it should appear here, credit balance. So you are supposed to write balance CD, sorry, here, because credit balance appears on the debit side if it is carried forward, but we are told it is zero. So what we do, we now balance off our control account. We balance off our control account. That is what we are supposed to do. We balance off our control account, and that is the end of drawing the control accounts. Now if you get into balancing the control account, you'll allow me to do it. Control accounts, if you have to balance it, this is how it should be. This is how it should be. We say that 699 plus 8503, this one gives you 12,202. Then the other side we have 154, we have 183, then we have 46, then we have 69, 64, then we have 95, then we have 10, and then we have 50. So a total of 75. That is the total, 7502. So you minus 7502 minus 12,202 minus 7502. So you get the balance here of 4,700. So that your account balances at 12,202. Your account balances at 12,202. The other side the same. You get to the creditors. We have 988 then plus 29 63. That one gives you 39.51. Then if you minus, then it should be 63 the other side plus 110 plus 26.49 plus 60 plus 50. So it gives you 29. Total here is 29.2. Now if you minus the other side, it 39.51 minus 29.2, it will give you 10.19 as our balance carried down. So that is how we usually draw control accounts, and anytime you are given control account, you are able to remember what unusual balances means and how you can place them towards the end and towards the beginning. Remember how you control, you are able to draw and to get the balances of your control account. Very, very important. Now, sometimes, remember I told you one of the reasons of control account is actually trying to check errors. It is actually trying to check errors, and that is now what I want us to do. We do a question on how to check the errors, and this is the question that I want us to read on how to check errors, so that we can know whether we are able to control our errors, whether we are able to correct our errors, so that we do not go with the wrong figures when we are drawing the balance sheet and other financial statement. And therefore, the question reads, the following information relates to Roxy Limited for the year to that 1 May 1983. Extract from the purchases ledger control account. Remember, this is the purchases ledger now, and we have the balances are trade creditors as at 1st June 1982. Remember, that one is the first balance, 20,000. Purchase credit purchases to 40,000. Payments made to creditors, it reduces the amount of credit, and discount received, it also reduces. The accountant has extracted a list of credit balances which total to 23,800. So when he was looking for credit balances, then the accountant came up with the figure 23,800. There were no debit balances. In checking these credit transactions, the following errors were discovered. Number one, goods costing 1,500 and been omitted from Collins' account. That means it was meant to be in the creditor's account, but it was not there. What is the effect there? You have to keep on asking yourself that particular question. What is the effect of omission on creditors? Then number two, discount received for January 1983 amounting to 500 and not been entered in any of the personal accounts. Then the credit signed of Brown's account and been undercast by 1,000. Then a cash payment of 200 to Almond and been credited to his account. You know, it was a cash payment and it was a creditor. Now debiting, it should have been debited because you are reducing his debt. A creditor being a liability, when you are reducing the debt, you should debit. But what happened? They credited. So you need to keep on checking such kind of things. Bank payment to Martin 750 and been omitted from his account. Ashton's balance 2,000 as and not been included in the list of balances. The entry for a motor car purchased. Now that one is a capital expenditure. It should not appear in creditor's account. It should not appear in debtor's account. It should appear in the general ledger. So putting it from Jill costing 5,000 should not have appeared in the purchases ledger. They are correct. Then discounts allowed totaling to 350 and been debited to cross-based account. Required, we are supposed to prepare purchases ledger control account for the year May 31st, May 1983, and a statement that shows the corrections that need to be done. Now, for us to be to do that question, we only require to draw the purchases ledger control account, and once we draw the purchases ledger, we ask ourselves, what is the balance brought down? And it is given in the question, the trade creditors as at the 1st June 1982, which is 20,000. So we have 20,000 there. Then anything that earns to the creditors, credit purchases, it earns to the creditors. So credit purchases of how much? Credit purchases of 240,000. 240,000. Now, credit payments mean to trade creditors. Now, if you pay trade creditors payments, it simply means you are reducing them. So 232, 200. So you debit the creditors account, and then discount received, it also reduces. Discount received, it also reduces, and the discount received was 6,000. So we'll have a balance here. We'll have a balance carried down of creditors by balancing. That one is the creditors account. This is 260,000. 260,000. This is 238, and therefore we have a difference of 22,000. We have a difference of 22,000. That one is what they wanted us to check in that particular statement. But we have been told the accountant, when he is extracting the balances, he realizes that the balance is 23,800 rather than being 22,000, rather than being 22,000. And therefore, what is he supposed to do? We are supposed to reconcile now the two balances. We are supposed to reconcile the two balances. And how do we recognize? Do we reconcile the two balances? Now, you need to look at error. You need to look at that error, the error that was committed. You look at the effect on creditors, effect on creditors, because we are dealing with creditors in this case. And after that, we ask ourselves, how do we correct the action to correct action that we need to do for us to correct? Once you have a table like this one, it will be very easy for you to be in a position to know how to do it. Now, error number one, goods costing 1,500 and been omitted in a creditor's account. If they have been omitted on creditor's account, it means that we have less creditors, and if we have less creditors, then we need to add to the balance that the accountant and obtain. Error number two, we ask ourselves, remember the value was 1,500. Now, error number two, this is what and 50. Let me write the value somewhere so that we do not reinvent the wheel. Discount received amounting to 500 had not been entered in any personal account. Personal account, they are the accounts of creditors, and that simply means that if it was a discount, it was meant to reduce creditors. It never reduced the creditors. It never reduced the creditors, and therefore what happened? Error number two, the effect was there was an increase in creditors, and therefore what we do is we should deduct the discount. We should deduct the discount from the creditors, which should be 500. That is something that you need to do. Number 3 error, we are told the credit signed of Brown's account, Brown's also is a creditor, had been undercast. Credit signed, remember, with the increase in liability we credit, and therefore if the credit signed of a creditor was undercast, it simply means that creditors had been reduced. So this one, they were less, they were reduced, and therefore if they were reduced by this amount, 1,000, then we are supposed to earn 1,000 to it. We are supposed to earn 1,000 to it. Then number 4, there is this question on number 4. Cash payment of 200 to Almond and been credited to his account. Now every time you mistake, there is an error in the signed, then you use double the figure, one figure to cancel the transaction that you had already done, and another figure to now record. If you put the same figure, like if an account looks like this and I had mistaken this signed 100, I put the other signed 100, it simply means those two cancel each other. So if I have to change the signs, I have to put 100 here and another 100, so that I can be left with 100 on this side. That simply means because the account was credited and it was supposed to be debited with 200, it simply means that we should debit it reduced. We should debit with 200 and another 200. And that simply means that creditors were actually increased because they were credited. To credit creditors, it simply means we are increasing. It was increased by 400. So it was increased. It was increased by double, and therefore we are supposed to deduct with the double. We are supposed to deduct with double, and double is 400, not 200. Number 5, a bank payment to Martin. We were paying a creditor 750 and been omitted. It simply means that we increased our creditors because we never showed that we reduced that creditor. So we are supposed to deduct the 750 because we had not shown that that creditor has been reduced. It was omitted. Then number 6, Ashton's balance of 2,000 and not been included in the list of balances. That means we never showed it in the list of balances, and therefore we reduced the value of our creditors, and therefore we should earn the value of our creditors by what? We should earn the value of our creditors by 2,000. That is something that you need to do. And then from there, what happens is that there is the entry number 7 of a motor vehicle purchased from Jill costing 5,000 should not have appeared in the purchases ledger. That simply means it increased our value of creditors, and therefore we should decrease. It increased our value of creditors, and therefore we should deduct it. We should deduct with the 5,000. And number 8, discount allowed totaling 350. Remember, discount allowed is of 350 and been debited to Crosspay's account. Crosspay, remember, it was discount allowed. It should apply to debtors, not to creditors, and therefore, and debiting Crosspay, it simply means that we decreased creditors, we reduced creditors, and if we reduced creditors, then we are supposed to earn creditors with how much? We are supposed to earn creditors with 350. Having analyzed all this very easily, now it is the high time you draw the reconciliation statement. If you look at our action here, we are simply saying that there are few things to add and there are few things to deduct. There are few things to add and there are few things to deduct. And therefore, when you are drawing your reconciliation statement, this is what you do. You say balance as per the accountant in error. Balance in error as per the accountant. It was supposed to be 23,800. It was supposed to be 23,800, and because it was supposed to be 23,800, what you do is that you add whatever is supposed to be added. You add items 1, 2, 1, 3, 6 and 8. Now items 1, 6, 3 and 8 is 1,500, it is 1,000, it is 2,000, and it is 350. Now if you add all this, it will definitely give you a figure like 4,850. 4,850. You add that. If you add that, you get 28. You get 28,650. 28,650. Now you less the other items. You less items 2, 4, 5 and 7. Now items 2, 5 and 7 should be 500, 400, 750 and 5,000 and 5,000. Okay, the total there will be 900 plus 750 plus 5,000, which should give you 6,650. Once you get that, then it will give you the correct balance, and our correct balance, which you should take to the financial statement, should be 22,000. Now if you look at this 22,000 and this 22,000, then it is actually the same figure, and therefore you have been able to reconcile. That is what it is all about regarding control account. Otherwise, thank you. Keep on listening to us in Achievers College. In case you have any question or any assistance or any resources that you would want to get from us, kindly you can call the number appearing on the screen, or you can reach us through www.achieverscollege.ac.ke, and we will be in a position to give you more details. Otherwise, thank you so much.